All right. Good morning, everybody. Hope everybody had a great Thanksgiving with their family. Just remember, if you want to make sure your microphone is muted, and if you want to turn the camera off, you can. All right. All right. A few administrative things. Midterms. Everybody has turned those in. I will release the scores this afternoon. I could not release a copy of the exam. We still had a couple classroom classes that had to finish up the midterm. I'm sure some of you don't know anybody else, but we just wanted to make sure that everybody had an opportunity to take the midterm before we release copies of it and the scores. So I'll be sending out your results this afternoon, as well as copies of the return to show you the answers on both the written and the computer portion of it, okay? Also, I had sent out to everybody, if you have completed the midterm and you have acquired a passing grade, I would have sent out to you a, are you interested in working for EG tax letter? Please let me know in the chat if you did not receive that. Again, like the last class, we've had a little wondering where some of our emails have gone because of the transition over, but I just want to make sure on this. So if you're not in class today and you're watching the video, this is being recorded, so they can pick up on that also, okay? So we have those two things. That do you want to work letter? I mean, obviously, some of you in the class, if you're in the Midwest or you're down in the Carolinas. I know we have an office in Florida for those that are interested, for those that are taking the class from Florida. But if you can get that back to me as soon as possible, if you're interested in working in one of the offices, it's a great opportunity for you. It's you know, a nice little part-time job during the cold winter months in Buffalo, between January and April. All of our offices are open 6 days a week, 9 to 9. We have a couple mall stores that are open on Sundays also, just because of that. So I will make sure that you have that, and that way Maria Rickard, our district manager who does all the hiring, will be in contact with you. So I will make sure that everybody has that, okay? One other administrative thing for you here, okay? If you follow us on Facebook, you probably saw it, but we do now have an EG Tax app, okay? So if you download it, put the little red EG, like is over my shoulder and on my screen. The app itself is great, has many tools, calculators, things about tax law, blog and news from Esther, especially her perspective on things like last night. At 2 a.m., the Senate passing the tax reform bill. I'm sure some of you have been following that and kind of had some interest in it because you hear some of the terms that you know from class, but has mileage trackers, has receipt trackers, has many other things. There'd be ways to contact us, website, other financial news, currency converters. So that would be great, okay? So if you want to download that, it'll keep you informed on everything that's going on, and tell your friends about it. So we want to try to use it in cooperation with our website that we'll be rolling out shortly. Okay? All right. Today, chapters 13 and 14. I've already have some, I guess, let's see, what do I want to call it? Inquiries or some mystified people to talk about. We're going to do some, all the things on the business. I believe that if I'm correct, we're on chapter 13 and 14. I don't have my syllabus here, but one of the things, I had somebody already this morning pop a chat into me that said this whole depreciation thing has got their head spinning. So we're going to go through it. I'm going to simplify it. This chapter and the next, or I should say these two chapters, and then the next one on rental income. There are two chapters that there's a lot of material in there, but you know, some of it's going to be just good reference for you. Some of it really isn't going to pertain to you doing basic tax returns. We'll touch on some of the subjects, but again, we're going to do, we'll be doing some problems at the end, as we do usually, and then we'll be covering the materials so that you fully understand what these things are within almost like a little tax return within inside a tax return. Okay, so we're going to work on that. All right. Okay. I got a couple messages. I'll make sure I go back and take a look at those regarding the interesting to work and stuff like that. So I will talk to you about that, either, later when I come back and address those when we wrap up, or chat with you individually on those during the breaks. Okay. All right. So we're going to get right into it with chapter 13. Okay. On chapter 13, we're going to talk about part 1 of what's called the Schedule C. Okay. We're going to be looking at business income. All right. Again, business income, this is for somebody that is self-employed. So you're not working for somebody else. You do not have a W-2. You've started your own business, and you may be what's called a sole proprietor. Okay. And we're looking to, just like a corporation would do on their tax return, we're looking for our income, we're looking for our expenses, and then seeing what our net profit is. That net profit, just like a corporation would be, we are going to be taxed on it. All right. So when we look at the net profit, we got to figure out how we're going to calculate that. You see, and when you did your reading and stuff, there were a Schedule C and a Schedule CEZ. The CEZ, obviously, if you have somebody that has a fairly small business, that they can do that CEZ because, there's certain thresholds and things that we'll talk about. What I want you to kind of understand that you can probably do most of your work, and you'll want to do most of your work on a Schedule C itself because it has some more parts to it. It's great when you're doing a client's tax return because it allows you to have those questions and those topics to ask a little more about the business and maybe delve into a little more that they didn't have this realization that there's certain expenses that they can write off. Okay, so we want to make sure we talk about that. Once we're done with what we do on the Schedule C and CEZ as far as income and expenses, that's when we will calculate the self-employment tax. Self-employment tax is no more than your Medicare and your Social Security on a personal tax return. So your net profits have income tax, just like your W-2 would, but in addition to the net profits, because you do not have a W-2 with those withheld, you have a self-employment tax that's calculated, Social Security and Medicare. We already talked about in adjustments to income, the credit or the adjustment to income that you get for your self-employment tax. That is half of that, just like an employee would. Okay. All right. So we have those. All right. So let's get right into it. Again, we're going to talk about sole proprietorship. We're going to talk about partnerships, a little bit definition of statutory employee. We're going to talk about how we get our income and cost of goods sold and expenses onto a Schedule C. All right. Now, a sole proprietor is just that. It is an individual who owns a business. Okay. They can be an LLC and be on a Schedule C, but if they end up and they do where they incorporate themselves, maybe do an EIN where they have employees and stuff, then they'd go on and become an S or a C Corp or maybe even a partnership, and they'd be doing a different return. They'd be doing an 1120 for the corporations, or they might be doing a 1065 for the partnership. Those returns are done separate from your personal return. You get a little thing called a K1 from the results. The K1 is like your W-2 for your corporation. That W-2, or excuse me, that K1 then transfers over to your personal return, and we'll talk about that next class when we talk about the Schedule E, because it comes over onto the Schedule E from your corporate return. Okay. You can be in a partnership and be on a sole proprietor if you are a qualified joint venture. So as it says there, if a taxpayer and their spouse participate in a business together and it's the same business, they can make a joint election and be treated as a joint venture and still be on a Schedule C. Then they don't have to do the Form 1065. Just remember with the 1065, even if you've chose to do a partnership so that you're not on the Schedule C, 1065s, when that income comes over to the personal return, is still subject to self-employment tax. Okay. Schedule C versus Schedule CEZ, okay? As I said, the CEZ is great, for that person that just maybe has that small little business where they're just making widgets to sell at the craft store, or excuse me, the craft fairs. It's not a hobby, but it is a business for profit, and that's where we can use it. So if you look right here, the great little flow chart that's up there, you can use that CEZ if you had business expenses of less than $5,000. Use a cash method of accounting. You do not have inventory. You do not have net loss from your business. So if we have a loss, we cannot be on a Schedule CEZ, and had only one business as either a sole proprietor, okay, or qualified joint venture or statutory employee, okay. Also, you had to have no employees. So probably on a Schedule CEZ, we're not going to see EIN numbers. You do not deduct expenses for your home. There's not part to do that on a Schedule CEZ. And also, you're not required to file any 4562s for depreciation. All right, we'll talk about that in the next chapter, but that allows us to stay on that Schedule CEZ. Okay, all right. And again, as we go along, make sure if you have any questions, just type them in the chat. We'll address them as we go along, okay? All right. The IRS determines that you are in a business with the intent to make a profit, okay? If you do not make a profit and you haven't, and you show losses on a continual basis, the IRS is then going to say to you, well, I don't think you're trying, and you, this is just a hobby, okay? And then we have to handle it different. We would have that hobby income on line 21. We would have maybe some expenses on our Schedule A, but, a little bit different that the way it's handled, because then the expenses aren't directly in line with the income. So just make sure that we have that, okay? Accounting methods. Again, most of our small businesses, what we're going to do is we're really going to stay within the realm of cash basis, okay? What I mean by that, when does the dollar change hands? When you're doing a sole proprietor Schedule C, that's 99%. It's just going to be on a cash basis, okay? The other thing that comes into play, as you see in the middle of the page here, is estimated taxes, okay? With the estimated taxes, we have where we can, because we have a profit on our business, we don't want to have to wait and pay tax on everything at the end of the year. So it's a very good idea if there's a profit, even a small or even a sizable profit, that we do pay estimated taxes as we go along through the year, okay? Again, talks about the material participation. So one of the questions we're going to see when we do the problems on the Schedule C is that if you are materially participating in it, and it has some tests here that you should be aware of when you're asking somebody if that's what they're doing with their business, okay? We have to make sure, again, that we're making a profit, okay? If somebody shows losses in a business for more than 3 or 5 years, the IRS is really going to start to question that, okay? Statutory employees, we're going to touch on that just a little bit here. You don't see a lot of those anymore. It goes through some examples here that's great, that shows about that. But a statutory employee still has that W-2 for an employer-employees relationship, but the income that they have for there is treated a little bit differently. It talks about the statutory employees for tax purposes fall within one of the following 4 categories and meet the 3 conditions described under Social Security and Medicare taxes below, okay? So basically in the help box, great little summary. A statutory employee is an employee for Social Security and Medicare tax purposes, and a self-employed for income tax purposes, okay? So again, you see a W-2 here for a statutory employee. Note that in box 13, you can see that it's checked statutory employee, okay? That person has, as you can see on there, things in box 1, 3, and 5. So they have boxes 4 and 6 where they are an employee for the purposes of their Social Security and Medicare, unlike our sole proprietor that pays that on their tax return. But they are calculating it, their income tax on the personal return because there's no income tax withheld. Okay, and again, you just don't see a lot of these statutory employees. You know, you look at the categories that they have, but a lot of the things that you see on there, they just, you know, they don't pertain to professions much anymore. There's a few. The most common would be somebody in the insurance industry where they are working as an employee for a ABC insurance company, but because of the way that the insurance companies work when they're selling their products, they're a statutory employee as far as that income that they receive. Okay. All right. Business income and expenses. All right. So we're going to talk about our Schedule C. All right. That is where we do this. And again, just like a business would do their return on an 1120 or 1065, if they're in that, then this is something that you would be able to see that we have that is basically like a little tax return. All right. Because we have a header, just like we would on our 1040. All right. So in that header, we're going to put who the owner of the business is. In a joint venture, it's the primary taxpayer on the tax return. It can be the spouse, but typically it is the primary if it's a joint venture. We got to describe the business that they're in. What are they doing? What are they selling? What are they, what industry are they in? Are they a widget maker or are they, selling Mary Kay? Okay. Business name. If the company has a business name, we put that in there. Now, to the right in box B and D, it talks about your code and it talks about your employer ID. On some following pages, there's a little summary of the different codes that are most prevalent. If you don't know the code, you can type it in just to Google and NACIAS, you type that in code and give the business. And a lot of times it'll just bring it up and it'll give you what the proximity is to that 6-digit code that you see there. The EIN number, again, we'll talk about that a little bit here, but you really don't have to have an EIN number unless you're going to do something, and you must have to if you're going to have sales tax, if you're going to have employees where you're going to be paying people on W-2s, where you have to pay employer tax. So there are a few things that you would have to do there that EIN number. EIN numbers are very simple to apply for. You can go online. Takes you just a few minutes through the IRS website or an SS4 document to get that EIN number, okay? And as we see here, this is the little chart I was talking about. If you note up there, like I said, that on the top, we have up at the top, I talked about that little 6-digit code based on the North American Industry Classification System. All right, so that's why I say type in NAICS code and then put it whatever your industry is, and that will, give you that opportunity to see that different code if you can't find it in the tables here, okay? So that's just another way for you to be able to look up that code. Try not to use the 6 nines, okay? I know that is available if no other code applies, but, in recent years, the IRS has been pretty stingy on not having people use that 6-digit code. So we want you to make sure that you're using a 6-digit code that pertains as close as possible. Doesn't mean you have to find an exact match, but as close as possible, okay? For a lot of people, like I said, a lot of people are doing direct sales, okay? And if you take a look here, I'm going to kind of show you this one right here, and you look down at the bottom of the chart, all right? This is one that comes in a lot because we have non-store retailers, okay? And it's basically talks about other direct selling establishments, including door-to-door retailing. What I'm talking about there, that's your Mary Kay. That's your, anybody that sells stuff where they do house parties or direct sales of products or anything like that. There's a ton of them out there, healthcare stuff, as far as vitamin. I mean, a lot of people have their own little home-based business that they're selling products. A lot of them do not have inventory. They're not making anything because it's a direct sale where they sell the product. They order it from a company and it's shipped directly to the customer or the client, okay? So that's one that you will see quite often, all right? Okay. All right. Okay. Great little chart here in the middle. Talks again about that do I need an EIN number? Like I said, some businesses, it gives them that sense of closing the loop and say, hey, I'm really in business for myself. So that EIN number, they like to have that. It's a way, too, for you to use something other than your Social Security number to identify your sole proprietorship. But, again, not necessary in all situations, all right? Talked about the SS4, and there's that link that you can use to go online to create that EIN number should you be in business for yourself, okay? The online is much easier than what you see here. Like I said, it does not take long for you to go through, ask you some questions and about getting things set up, all right? Next section in the Schedule C, all right, you can see there in the middle of the page, it has a little cutout portion of what we have, all right? So we have there what we're going to answer these questions. Our questions F, G, H, I, and J, okay? Counting method, again, 99%, everybody's going to be in that cash basis, okay? Did you materially participate? Obviously, we've talked about that. The IRS is interested. Are you trying? Are you really in business? Okay, so we have that. Did you start the business during the year? Okay, that's a question that you'd have to check if you did. And then it asks you, did you make 1099s? Okay, if you have somebody that maybe works for you, you make widgets, and you have somebody that comes in and, the last stage to put them in a box, you hire somebody to work for you that you do that for. Well, they're maybe not an employee. They can make their own hours or whatever it is to make them not classified as an employee, that they'd be an independent contractor on their own. Then you'd have to do the 1099, okay? Question about 1099 for subcontractor. Yes and no. It depends on the relationship within what the relationship is between the person that's coming in. A lot more so is, if you have an expense where you're paying somebody to do something for you, it's just a way for you to create a paper trail, especially if you paid them over $600, because we remember back there on our 1099 miscellaneous what our stipulation is for a 1099 being issued. It's just a way to, and like I said, prime example, I have a client that drives his own truck for a moving company. He drives all over the country, moving people from Buffalo to wherever they're moving, or vice versa, moving to Buffalo. That being said, he has contacts in the larger cities so that when he gets there, he can call up and he has people come that help him unload the truck. Okay, he's not traveling with them. He's not really having them as employees. They're not regular employees. They're just somebody that he has help out and he pays. And in order to keep track of his expenses, he issues them a 1099 after he pays them, okay? He's not withholding taxes or anything like that, okay? All right, so we have that, and then it talks about, again, like I said, about the 1099s that we have in there, all right? Okay, a couple little exercises in here for you. Again, just getting you used to the fact of how you fill out that Schedule C, okay? What you need to put in there, the information, all the things that we have on there. All right. Income. All right. So obviously, if we're in a business for ourselves, we have income. Okay. So a lot of stuff in here, a lot of verbiage, a lot of things. But basically on line 1, we're putting in what were our sales. Okay. Talks about the fact that on a W-2 for a statutory employee. All right. That's what we have there. But for our business, we may get a 1099. We might keep track of expenses in QuickBooks or in a ledger or just even a spiral notebook where we say we sold this, this, and this. Or sometimes, like I said, I bring up the Mary Kay. We're tolling up the little receipt things, the carbon ones that we fill out, give one to the client and one for our records. We might get a 1099 miscellaneous from somebody else. Sometimes what happens if there's more than $5,000, a Mary Kay person that has $5,000 in commissions and things, they would get a 1099 miscellaneous from the parent or the corporation company that they would have to report. Another one is 1099Ks, your PayPals, things like that, that third party. Maybe you have a Square where you take credit card charges, different things like that. So you may get one of those instead of a 1099 miscellaneous to show you had income, from sources as receipts from your business, okay? Again, great material here as far as everything, all the different parts that would make up that income, but just make sure you understand that, you know, we're just trying to get our gross income, okay? Now, that income on there, if we look at it, has different portions, okay? It has a portion for returns, okay? Somebody's not happy with what you sent them. Their widget doesn't work the way you said it would, so you have to refund them. That would be something you put in there. Again, no different than any other business, okay? We're going to talk about cost of goods sold in a second. We get our gross profit, obviously profit, you know, things like that. The other things, some other income that we might have in there with the third party, okay? So we're going to get our gross profit. This is the number that we're going to work off when we start looking at our expenses to put against what generated that income, okay? Now, if you are in a product that I had a question, would spoilage of inventory be an allowance? We're going to kind of talk about, yes, you could put it there. I would maybe put it even as an other expense on the Schedule C that we're going to talk about. It is, you know, if you have a loss of inventory on there, but we'll kind of look at it too. It can be in multiple places. You just need to make sure you're descriptive on what that is, okay? All right. Again, cost of goods sold. Basically, you know, expenses that you figure in a cost of goods sold is the cost of the products or raw materials. I always use the example, the birdhouse, okay? Gentleman's not buying the birdhouses, he's making the birdhouses. So he may have materials, wood, nails, things like that, the raw materials that, you know, he purchased to make his product, okay? Talks about storage, labor, you can put that on here, factory overhead. Again, you know, when you have a sole proprietor, some of these things sound like, you know, what's he really doing? It sounds like it's more of a corporation or business. It is, but it's on a smaller scale. So that's why there's some of these terms in here, because those are the same things that you'd see on a corporate return, okay? So we have our little section here, part 3 from the Schedule C, that talks about cost of goods sold, all right? Valuing our inventory, again, use the cost, okay? It assists you, it's consistent. It's nice with the cash basis that we use that cost method, okay? Obviously, if we're going to be calculating cost of goods sold, we have to start with our inventory. What was our inventory at the beginning of the year? All right. We have purchases less any items withdrawn for personal use. Again, when I talk about a direct salesperson, somebody that they're selling these special vitamins over the internet, did they take some of the bottles to use personally, or, you know, to give as gifts or whatever it may be? So they had some personal use. So you cannot take those as cost of goods sold, okay? Cost of labor, again, doesn't come in a lot. Most of the time, you know, that's contract labor that we'll see in the other side of the expense, part 2 on the Schedule C. But, you know, this is one too. We can put this there if it relates directly to our assembly. Again, I use the situation of the widgets. You know, you got somebody that comes in that their specialty is putting part A on part B of the widget. That's what they do for you, then that's part of your cost of goods sold, okay? Materials and supplies, we kind of talked about that. Other cost, you know, we talked about a little spoilage. Somebody was asking about that. Could be a spot there. You know, if you have, I guess if you have wood as a birdhouse and it's been sitting somewhere and all of a sudden that wood becomes unusable, it might be another cost there for you, okay? And then obviously we get to inventory at the end of the year. What do I have left over, okay? Because those are not in my product to sell for my gross receipts, so I cannot use those in there. That gets me cost of goods sold, okay? Again, you know, seems like a very heavy accounting thing, but most of the time what you see is you're going to have that beginning inventory, ending inventory, and purchases, all right? Because a lot of people are direct sales. They have something that's already put together for them. They're just selling a product. If they have product that they're keeping on hand to sell that is not already sold, then they're going to have inventory, okay? All right, little exercise, doing some calculations here on different things as far as your Schedule C, okay? And working off those with the income and things like that. All right, just as any other business, okay? We've made this profit, all right? And we have expenses to do that. Again, talks about, we've heard this term before, ordinary and necessary. An ordinary expense is one that is common and accepted in the trade or business. A necessary expense is one that is helpful and appropriate for the trade or business. Basically, what it's saying is our expenses have to be things that are generating the income within our business entity or our thing that we're materially participating in, okay? So, expenses paid in advance, an expense paid in advance can only be deducted in the year in which it applies, okay? So, a calendar year taxpayer pays $1,000 in 2016 for a business insurance policy effective 1 year beginning July 1st. $500 is deductible in 2016 and $500 in 2017, okay? Again, we're on a cash basis, okay? We had a question, are expenses the different elements of overhead? Can be, you can look at it that way. Again, I look at them more as operational expenses. Overhead can be a term that you could use. You know, we always throw the term around when you look at somebody, if they're in a consulting business, they don't really have a lot of overhead because they're not making anything and they don't have a physical, tangible product to sell. On the flip side, we have somebody that is a Mary Kay. Well, they have a physical product, so their overhead would be cost of goods sold and the expenses. So yeah, overhead can be looked at, you know, you can consider it overhead, okay? All right, we have expenses. Like I said, you start looking at this, and this is part 2 of the Schedule C. We really start to pick it apart, and we look at the different things that we see here. We have all these items. It's just like a corporation would do. You know, if you were to take, you know, ABC Corporation, a big company making millions of dollars, and you start to pick apart their financials, you know, you're probably going to see a lot of these topics because these are the areas of expense that generally are accepted for them. Obviously, the bigger the business, the more line items you would have. But for our little Schedule C, our sole business, sole proprietor or small business, these are the categories that we're going to get into, okay? Advertising, you know, if we start looking at line 8, you know, did I take an ad in the paper? Did I put a little radio spot? You know, things that I paid for. Business cards, flyers, different things like that, all right? Now, as far as what I give you for all these expenses, the big thing is when you have a client, you want to make sure that there's a mutual understanding between you and them, that they understand what they're recording and that you're consistent from year to year. We do not have to have somebody necessarily when they start a small business become an accountant and get into QuickBooks, okay? Last thing I want for some of my clients when they're starting out with their new business is spending 4, 8, 10 hours a week putting things into QuickBooks and learning how to use QuickBooks when I want them out there making their business a success, okay? So, some type of system. It can be a little accordion file where you're sticking the receipts in and then you add them up at the end of the year. It could be going to our app and putting things in there, scanning the receipts and put them in the thing, and at the end of the year, it spits out a little spreadsheet for you that summarizes your expenses, okay? It could be just the fact that they take and when school supplies are on sale and they buy that 59-cent spiral notebook or marble notebook, and they just have pages with little tabs or whatever, and they were journaling and writing in those expenses and income, or they have a calendar, you know, again, many different ways. But you have to be consistent, and they have to be able to justify and support with their bookkeeping that that expense relates to the income generated within that business, okay? Car and truck expense. This is where, as a sole proprietor, you have a little bit more latitude because you're able to do vehicle expenses based on your travel for business. You get that, you know, in this case, in it's 2016 when we're doing our problems, our 54 cents a mile, okay? But, you know, you can track that. We'll see that in a second when we talk about the mileage expense that's on the back part of the Schedule C in Part 4, okay? All right, and here it is, okay? When you do a business, you have a vehicle, so, you know, even if it's a personal vehicle that you bought, you say, when did you put it in service? The reason they do that is because once you've chosen whether you're going to do mileage or actual expense, that vehicle, you have to stay consistent, okay? You can't say, oh, this year I think I'm going to do actual because I had to buy new tires and redo the engine, all right? Can't go back and forth. Once you've determined the method that you're going to use for your vehicle expenses, you must stay with it, all right? We're going to put in our business miles, all right? And then it has some questions, kind of some due diligence to make sure that that vehicle can be related to the business, all right? Commissions and fees, again, directly what we just talked about, commissions and fees. You know, if you pay somebody, you know, you give somebody that works for you momentarily and you had a great December with Christmas coming up, selling your widgets, you might give them a little commission, you know, maybe on a 1099, but you can keep track of that, okay? Contract labor, we talked a little bit about that on the side with cost of goods sold. Payments for compensation paid to independent contractors and subcontractors, basically non-employees, okay? There's the $600 rule that we talked about, all right? Depletion, don't see a lot of that. I've had a couple clients in the last couple years that have had some things where they have somebody that they do have some timber harvesting on some property that they have in rural areas, but don't see a lot of depletion. You're going to see much more depreciation, all right? We'll talk about that in the next chapter, so I'm going to leave it there. We don't want to get anybody going too much through their head right now. Employee benefit programs, again, just what it says there. Insurance, other than health. Remember, insurance, you know, if it's liability insurance or anything else, the special insurance you have to be able to generate the income, but not health. That is an adjustment to income that we talked about in Chapter 12. Okay? Interest, all right, if you have mortgage interest paid to banks on real property used in business, all right? Did I buy a little storefront? Do I have a little brick and mortar? Okay? Other interests can include finance charges, business loans, and credit card purchases. Again, I go back to the Mary Kay. They have Mary Kay credit cards, where those are the credit cards that everybody uses to purchase their inventory, and they can pay that down because that credit card earns them points or discounts on different things, but they have a credit card that is in the business's name. Okay, so they are doing that there. Legal and professional fees, just as it says there. Okay, those are attorney fees that we have that would directly relate to that. Question on the cashback from credit cards? No, typically not. Okay, because that is probably after tax dollars. Unless it gets to a certain amount, they might issue you a 1099. Office expenses, those are materials that are needed to run the office. That's their pencil, paper, ink cartridges, whatever they may be. Okay, just regular day-to-day office expenses. We'll talk later about some of the things that might be depreciated, but we'll talk about those. Okay, pension and profit sharing plans. Again, line item like you'd see on a corporation, but you know, if you have somebody that you're putting a little money into, that's what that can be. All right. Am I renting as opposed to buying? I'm renting a little store, or say I have clients that are landscapers. Certain projects that they do, they have to rent a piece of machinery that is basically something that they use that's not part of their normal fleet or whatever you'd like to call it. So those are things that would be there. Okay. Repairs and maintenance, things to maintain the business property in order to ordinary and operate. Okay. You have a widget maker that you bought. Okay. There may be some repairs to it. All right. Has to be, somebody has to fly in from Germany because it's a special widget maker, you know, and you have repairs that you have to pay on that. Supplies, again, we talked about material and supplies that are things part of our cost of goods sold, but this may be something on the flip side. These supplies I would look at and see as things, again, I go back to somebody that's direct sales. I usually put supplies, you know, merchandise bags, gift boxes, things like that that are kind of the finish, you know, the packaging, or if you will, or whatever it may be. Taxes and license, they are part of the things that you pay, but as it says, caution, when you see the word taxes, sales tax collected on products and service income is considered pass-through. Pass-through taxes must not be deducted as expenses. If my gross sales include sales tax, I need to have people back that out. Sales tax is a pass-through. You're collecting it for the state and then paying it to them. It's not anything that really is anything that goes into your pocket. So sales tax is handled a little bit different. Travel and meals, Again, subject to saving those for as an employee. Utilities, I typically just use our traditional utilities here, where it's heat, light, power, things like that. I like to break out phone and internet in our other expense that we're going to talk about that's in Part 5 of the Schedule C, because I like to list the cell phone and the internet and do a percentage of use. So if somebody has a cell phone, and it's not only for business but it's personal, I like to break it out because then I can say on that line item description, cell phone used 20%. 20% for business, the remaining 80% for personal. Same thing with the internet. Maybe they're doing their sales on their internet, but their internet or Wi-Fi coming into their house isn't necessarily 100% business. Now, different situations, if I have somebody that is in a business as an independent contractor and they're required to have a high-speed line over and above what would be their normal service that they'd have, then that would be different, okay? All right. Okay, break out into what? I'm not sure what that one means. Okay. Okay, was the asking about telephone expenses. Again, like I said, I put it on the other expense line as opposed to put it in the utilities because I want to break it out a little bit more, like I said, with the percentage of use, all right? So if I have telephone expenses and it's a cell phone, I may not be using that 100%. So if I throw it in utilities, it doesn't give me a chance to have the description on it, okay? Wages, again, depends on what the wages, but there's a description of what wages could fall in there. And other expenses, again, these are things that I put in there that I don't necessarily find in my categories of the Schedule C in that Part 2. So I want to give a little more description to it, or it's not in there. Again, if it pertains special to the business, I might put things on there like website, okay? Uniforms. Again, I don't want to throw them into supplies because they don't have to do with my product, but those are things there. Sometimes with those dues to the professional organizations or publications or, seminar that I took, whatever it may be, I want to try to put those in, give them a little bit more detail. So I'll break them out and put them into that other expenses line in that Part 4, okay? So here's our Schedule C. Here's that part I'm talking about in Part 4. My other expenses listed, it gives me the opportunity down here at the bottom in Part 4 to be a little bit more descriptive. It's kind of like sometimes I'll talk about the scratch pad, or I'll have you in a sheet where there's another expense and stuff. It gives me the opportunity, and we'll see this in tax-wise when we do the problem, it gives me the opportunity to be a little bit more descriptive instead of just throwing it in one of those line items in Part 2 of the Schedule C, okay? Just again, for me, it's one of those things that gives a little more detail. Then it carries year to year for me. So when I talk to my client the next year, I can look and say, hey, I see we had a website development, okay? You still doing that? No, I dropped the website, okay? Or I created an app, or whatever it may be. Telephone, we got you using 20%. Is that still good? Type of thing. So it gives me some more detail to be able to make sure I'm getting the correct expenses for my client when I go to do their return, okay? A couple problems here where you get to do it the old-fashioned way. Our friends, the Boyds, as we go through, they've been doing a lot of things. They've been busy throughout our book, but it allows us to do different things here when we talk about their expenses and such that they have there, okay? Got one little statutory employee that they have you doing, okay? All right, so I know we went through that pretty quick, but I want to be able to spend a little bit more time when we talk about depreciation, okay? What we're going to do is we will take about a 5-minute break. If any questions come up, or I'll try to get in there to the chat and address some of those, okay? So we'll be back in 5 minutes. And again, if anything that we've covered so far on Chapter 14, we're not going to do a problem right now. I'm going to say the problem because we're going to do, in Chapter 13. Because in 14, we're going to try to do a problem where we'll relate to the two things together. So we'll see you in about 5 minutes, okay? All right, so we are back, all right? Like I said, a lot of material I covered today, chapters 13 and 14. Basically, we're learning how to do a tax return within a tax return, okay? Now, What we're going to get into next is we're going to start to talk about Chapter 14, Part 2. We broke this into two pieces for our business income, our Schedule C. We have our depreciation, business use of the home, clergy, self-employed, and the self-employment tax. Okay? Now, the gentleman that writes our book, Mark, does a great job here talking about depreciation, gives you all the great details, resources, all the different things. The hard part, I know I had somebody type in about the whole thing with depreciation, is when you're teaching depreciation to somebody, if they don't have a strong accounting background or haven't been doing this, sometimes depreciation is a little overwhelming. And the other thing is if you do have an accounting degree, chances are you probably had a class for a whole semester that you just did a depreciation. And here I'm going to try to compress that all into a short time frame. All right. So that being said, depreciation, it's not that hard when you just tear it down to its bare bones. Okay. So that's what we're going to do. Going to kind of just throw the book aside. I'll use kind of some of the topics there that are within it. Depreciation, what it is it's really just a fancy name for an expense. Okay. What we just did in the last chapter were all expenses that we were able to talk about that had a nice little line. Depreciation was one of those, but where expenses are something that we incur on a cash basis in that year and just take the expense. Okay. Depreciation is something that allows us to have an expense that we have choices with. Okay. We can take it all in 1 year. We're going to talk about a Section 179. We can take half in the year that we purchased it or had that expense of the depreciable item, so special allowance, or we can take it over its useful life. The accounting principles give us something that says how many years I can break up my expense into little bites. Basically, what you can do with depreciation is depending on your business or what you purchase, you can get those larger items that are part of your business that you can depreciate by the rules and take and match those up with the years that they generate income. So if I purchase a large machine to make my widgets, okay, and my machine's going to make me have income, that machine will last 7 years, I can take 7 years, I take the expense of that widget machine and break it into 7 years so that I can use it in all the years that it's making income in my business. Okay? So basically what I'm saying is don't get caught up in all of the terms and all the different things. I know we have makers, acres, GDS, ADS, all this stuff. We're going to simplify it as best we can and just always have the mindset that it is an expense. And it's just an expense that we have the opportunity to use in different situations in different portions. We can use it all, part, or none. Okay? So we may be able to take some of that way. All right? So just kind of remember that. We'll talk briefly about clergy. We're going to touch on the self-employment tax in this. Okay? Now, like I said, depreciation. This chapter, there's 50 pages, I believe, that are in there. But the thing is, we got to determine if it's something we can depreciate and then how we're going to take that so that we see how we determine our expense that we can use each year. Again, don't get caught up in all the terminology. Let's just keep it simple, okay? To be eligible for depreciation, it talks that it must meet the following requirements. Taxpayer must own the property, okay? Taxpayer must use the property in business or income producing. If the taxpayer uses a property for business and for personal use, you can have to break it down as a percentage. And the property must have a determinable useful life of more than a year. Okay, so it's something that I know that I'm not just going to be, again, maybe an example. Like I said, my widget machine. My widget machine isn't going to only last a year and then I throw it away. It's probably going to last me 5-7 years. So then I would want to depreciate it or expense it over several years. Okay. A taxpayer cannot depreciate the following: property placed in service and disposed of in the same year, equipment used to build capital improvements. Okay, so those are things that are a little bit different with that. Okay, the things that we have to be able to identify is, we're going to talk about the method and stuff like that, but really what we have to do, and the software for TaxWise is great, we have to know what the item is. Is it something we can depreciate? We have to make sure that we get it into its correct asset type. We have to know when we put it into service, okay? And then we have to decide the basis, all right? And the basis is going to be determined just like we've talked about with stocks, but what did I purchase for? What was the cost to me to get that? And again, how much of that is going to be used for business, all right? We get into the makers, acres, all the different things. Like I said, I'm not going to have you get caught up in all this because, again, it gets very heavy with the accounting terms. We're going to use makers, okay? We're not going to use acres. We're going to use makers because most things are going to be after 1986, okay? Again, placed in service. Make sure we know what class it falls in because that helps us with our useful life, okay, our recovery period. All right. Next, it gets into things that it talks about declining balance rate and straight line. We're going to use the declining balance rate most often, okay? It allows us kind of an accelerate thing where we get a little bit more of the depreciation early on if we use the life of the product, okay? Also, we have the two systems. We're going to be in GDS generally, okay? Again, ADS is there for your knowledge, but we're going to be in that GDS, okay? This is one of the important parts here, you know, the part where we talk about the recovery period, all right? Again, we're generally, and just know that you're going to be within these categories with makers recovery periods in the GDS right here on this side, okay? That's the column that we're going to use. That's the one we're going to talk about in the problems. That's the one we're going to use in our examples and the such, okay? So that's the one that we want to make sure that we use, all right? Okay. Conventions, again, don't get too caught up in it. We're going to use this example. We're going to kind of go through this one because this is a great way just to kind of understand the conventions. All right. So we have this right here, our nice little example that's here in the middle of the page. All right. So we're going to talk about conventions this way. All right. During the tax year, all right, we had Tom Martin purchase the following items for his rental property. He elects not to claim the special depreciation allowance. We'll be discussing that later. So he purchased a dishwasher for $400 that he placed in service in January. So let's do this. Give me 1 second here. Okay. So again, we're right down here in the middle of the page. We're looking at this example right here. Okay. So we have a dishwasher for $400 that he placed in service in January, okay? If we were to look at the conventions up front, okay, all right, we take a look and see treats all properties placed in service at the midpoint of the year. We have mid-quarter that's used if it's depreciable basis placed during the last 3 years and used as for residential rental as mid-month, okay? So this one we have a half year for January. Used furniture for $100 that he placed in service in September, and a refrigerator for $800 that he placed in service in October. Okay. All right. Now, as it says down here, Tom uses the calendar tax year. All right. So we're looking at January through December. The total of all the property placed in service for the year was $1,300. $400 dishwasher, $100 furniture, $800 refrigerator. Okay. Now we have to decide what we're going to use for this, what convention. Well, because the $800 or more than 40% of what we purchased was placed in service in October, which is the last 3 months of the year, then we must use the mid-quarter convention. Okay, we cannot use the half year. All right, okay, but that's the simple part on there. The nice thing again about the software when we show the asset worksheet is it gives you that convention, okay? The only one that a lot of times you'll have to fill in is used for residential rental property and non-residential real property is that mid-month. But most all the other time, it'll calculate and give you the convention. But you just have to know those simple little rules there for the convention, okay? All right, residential rental property, again, we'll get into that in the next chapter more so, okay? When we use depreciation there and talk about it, it's much easier to see in the problem there, okay? Talks about listed properties, you know, just know the categories that fall within listed properties, okay? When we talk about Part 4 here, talks about some things on a Part 4797. This is where we get into a little bit more with the sale or things with that. Again, we'll talk about that a little bit more. It's more common when we do that within the rentals, all right? Now, again, a lot of charts coming up, a lot of tables, things like that. Just kind of know that you know, get your system that you decide. You're going to, you know, decide what's your maker system. Again, most of the time it's GDS, depreciation method that we're going to have, our recovery period, the convention and or the class. Then it's going to talk about which table we use. When it says the table, it kind of gives us an idea of how we're going to use the percentages. So if I had a client come in that came into me and I was doing his tax return for the first time. And again, we'll see this more. There's a great problem that we do in the next chapter. But he comes in and he has his widget making machine that he purchased 3 years ago, but I have no history on his return. And I don't know if he's been depreciating it. Well, prior depreciation is part of that depreciation worksheet. We have to be able to calculate that. That's where we would use these tables. Again, tax-wise is great. But these tables, use them for reference because you'd need to know. So once you've determined what that would be within the asset worksheet to be able to go and find it to calculate the prior depreciation, okay? Section 179, okay? So we've determined depreciation is basically an expense that we take the cost or the basis, and we've decided depreciation is chopping it into little pieces for the number of years that we can take based on what we just talked about in our table, okay? Now, Section 179 is a different part, okay? Section 179 deduction is an exemption to the general rule against expensing in an asset in the year acquired. It also a taxpayer is to expend the cost or all part of certain qualifying property up to a limit. Basically what the 179 is, if it qualifies for it, and we have our little rules that are in here, is that I have the option of taking, you know, all the way up to 100% of that expense in the year that I purchased it, okay? Sometimes when we purchase something at the end of the year, we might have a business that purchased something in December, and because of the way that the calculation works for depreciation with the time that that was purchased that mid-quarter, then we get a very small portion towards our expense in that year. Well, maybe that doesn't work for us. We're going to do one example problem that really shows that, okay? But in this case, we have the election that we could take all the way up to 100%, okay? So, or I could take 75%. It gives me the option of being able to really front load the expense in the year that I incurred it instead of waiting for it over those years, all right? Now, the one restriction that we have to have is that it must be acquired or purchased from a non-related person during the tax year. It may be either new or used, okay? So that's one of the things to keep in mind. It can be new or used, all right? A little bit about the deduction, the limitations. Again, don't see that a lot, especially in the small business, but we'll talk about it more when we do chapter, I keep referring to the chapter. Let me get a chapter number here for you. Chapter 15 when we get into rental income, our next chapter, okay? So again, Special 179, we're going to see it in action when we do the problem, but it's much more something where I can take and I can use as much of that depreciation in the first year, okay? and I can only do that in the year that I purchased. I can't decide then the second year and says, hey, I'd like to do a Section 179. No, we can't do it that way, okay? Special depreciation allowance, okay? So we have this. Now our special depreciation, our rules are a little tighter, okay? Section 179, we could use up to that 100%. Special depreciation, we have to narrow it down to about 50%, okay? So we can take half the first year plus the remaining basis, that depreciation and over the useful life, okay? So again, special depreciation is kind of our next one. Says we don't want to use Section 179, take it all. We're going to say, all right, let's do special. I'm going to take half the first year plus a little bit of depreciation for that first year and then depreciate the remainder. Again, when you elect to do this, the only time you can do that is in that first year, all right? Now, one thing that a special depreciation allowance, a little limitation, as you see there, it applies only to new property, not used, okay? So again, a little bit different. So when we look at this, this is a simple part to look at it. I am sitting with my client. They purchased their widget making machine. I say, okay, we have a whole bunch of income this year and you just purchased this thing in December. We can take a 179 and put all of that expense in the year towards your income. But you have to explain to them, then they don't get to use the expense for the remaining useful life, the little portions, okay? Because they used it all in the first year because of their income. Well, that doesn't make sense. We're going to keep it that way. All right, let's look at the next one. We got some pretty good income. Let's use half of it. And then we still have half of it to use over the remainder useful life towards other years and income. Maybe that's a good idea. Well, this year's income is going to be the same for the next 5 years. My widget making machine has a 5-year useful life. Let's make sure that we can use a portion of it each of the 5 years. So you can see we can kind of match up that expense of that major purchase, you know, more than a year's useful life, maybe more than $1,000, and we can get it to match the flow of income to minimize their tax liability, okay? Really, that's what depreciation is. Trying to get that expense of that major capital purchase to match the flow of the income in the business. Because we don't want to waste our nice expense that we have on our big purchase in a year where we don't have expense, or don't have income to really put it against. Because again, as a tax preparer, you want to try to minimize your client's tax liability, okay? All right, now, we're going to do a few of these examples because I like to discuss it much more this way. Like I said, I know we went through a lot of material. Depreciation, I don't want you to get hung up on all the legal, or not legal, but terminology, that the accounting terminology. I just want you to treat it as an expense, and you're going to decide, hey, I got my depreciation pie. How am I going to cut up my pie, and when am I going to eat it? Okay? All right? Now, on this one, we see that Jay brought office furniture, 7-year property for $10,000, put it in service in August. He used the furniture only for business, and it's the only items that he bought. He does not want to do 179, and he does not want to do special depreciation, okay? We're going to do the GDS method, okay? So we got a little worksheet. Property class and recovery period, 7 years. We have it when it was placed in service. We have our depreciation rate from the tables, okay? So that 0.1429, it's not a number that we just pulled out of the air, but that is a number that we're going to use. So we have makers, GDS, 7-year, okay? We have that. So if we go back to our tables, all right, okay. Makers, GDS, 7, okay. And we have, it was placed in service any one of the periods, okay. Okay. Half year tends to give us the most normal when we look at it, and we're going to kind of show you that here, okay. So we have it in the cross, and with what that is, it's a half-year convention. So it's placed in service at any quarter. So we're going to use table A1, okay, because when that was placed in service. So if I look at this, okay, I can see here, I have my half-year convention, I have my year 7, and I have here, there's my percentages over that 7-year useful life, okay? So I have it where I get 14.2% in the first year, and then 24 in the first year. Then that, you can see how it declines down, okay? So pretty good. It gives me, in the beginning, allows me to get most of my depreciation captured. So something doesn't last its useful life, I at least going to get that depreciation up front, okay? Now, if I were to take that and I was not going to use it in that quarter, but I was placed in service the first quarter here, and I used the mid-quarter convention, all right? I can see here with my 7-year that I have more of it in the first and second year, okay? So that would be the case where you'd see the percentage be a little bit different. The second quarter, in this case, the August would be the third quarter. I don't get as much the first year. So I'm taking advantage of that half year because I'm going to get 14% as opposed to 10%, okay? And again, I might have a product that allows me to take Section 179 or special depreciation, so I can, take that. So if I, use the mid-quarter and I put it in service here, okay, I can see that in the mid-quarter 7-year, I'm only going to get that 10% as opposed to the 14% that I have in the other one, okay? Again, I'm choosing something that will allow me to match when the income is generated by my asset purchase, okay? So that's where we have that, all right? Now, back to my little example. We've chosen half year so that we have that our first. We have our basis. We turn that percentage into a decimal. So my first year, I'm going to take depreciation of $1,429, okay? So that's really the way that that works, all right? Okay? Now, have some exercises. I'll have you work on those, okay? But I'm going to do one with you here, all right? And I'm going to do this 14A because it kind of encompasses all of the things together, all right? Now, based on the 14A, let me just grab some here 1 second. Okay, let me get my little cheat sheet out here. Okay. All right. Okay, so we're going to take a look at this problem here. All right. So we're on in the workbook, or excuse me, in the textbook, we're on 1421. All right. So Bill Peterson purchased $750,000 of 7-year equipment for his business, 3 pieces at $250,000 each. That's his adjusted basis. So it sounds like there might be a machine that we had that was the installation or whatever. Purchased them in March, June, and October 2016. The equipment is 100% for business. The equipment qualifies for both the Section 179 and special depreciation allowance. Okay. None of the equipment is listed property, and none of the equipment is qualified Section 179 real property. Okay. Bill has business income for the year of $10 million. Okay. Obviously, he's being very successful in making widgets. All right. So his widgets in the 3 machines that he purchased for $750,000 in that year generated $10 million in sales of widgets. Well, obviously, we'd like to not pay tax on $10 million if we've been successful making those. Okay. So we're going to take a look. List the total depreciation for 2016. Fill in the worksheets. Okay. Everything that we have. We're just going to do the little calculations here. All right. So this little worksheet starting out, what we're going to look at is what is his limitation for Section 179. Okay. Well, if we start out with the cost of the product, $750,000 goes in that line 1. Okay. Tells us to enter the smaller of line 1 or line 2. All right. We have the $500,000 there. Okay. Won't worry about 4 because that doesn't apply to us. So line 5, it tells us add lines 3 and 4. We got $500,000. Okay. We're looking for the maximum threshold cost of Section 179. okay, before the limitation. Enter the amount from line 1, okay? We got line 1 says $750,000. Our maximum threshold cost of property is $2,010,000. And then it says the maximum elected cost for 4562 is the smaller of line 1 or line 5. Well, we see that's $500,000. So basically, we cannot exceed this amount. $500,000 is that limitation, or the maximum, for our 179. Okay? So, that being said, we have to determine how we're going to expense this for Mr. Peterson. Okay? If we take a look, we have the options of a 179, the special allowance, and the remaining depreciation. Okay? On the next page, there's a maker's worksheet. My classes, they asked me, well, why is there only one? I have 3 pieces of equipment. Yeah, we're going to talk about that. Okay? If I have $750,000 worth of equipment that I bought and I want to depreciate that, all right, I am going to take, all right, and I am going to depreciate as much as I can in the first year to put against my $10 million, all right? So we determined $500,000 is our maximum 179. That being said, a 179 allows me to take 100% of the depreciation in the first year. So my press number 1 to make my widgets, $250,000. Press number 2, $250,000. Okay? I'm going to section 179 those. So right there where it says equipment, section 179, I'm going to put those in as $500,000. Okay? I'm going to 179. That means I took all of it in the first year, and I'm not going to depreciate any of the other stuff over the remaining 7 years. Okay? Now, that being said, my next one, I can elect to take special allowance. All right? So I'm on the machine number 3. I've already depreciated the first 2 full amounts as a section 179. Now I'm on the third $250,000 machine. Okay? I am going to take special depreciation allowance, which gives me half of my $250,000. So my first part of my depreciation for special allowance is $125,000, or half of the price. The last thing I'm going to do is my remaining $125,000, I'm going to calculate my depreciation. Okay? So, that being said, that's where we're going to use the little chart, okay, that we have on the next page. Okay? All right. So, we're going to go into this one. So I'm on my third piece of equipment, all right? We're going to use GDS, if you want to fill it in your book as you're going along here. Question 1, we're going to use the GDS. I have a property class 7 years. I placed it in service in October. I'm on my third piece, my October piece. I'm going to have a 7-year recovery. I'm going to do a maker's half year. And then I'm going to use the 14.29%. Okay? So when I start out with my cost basis, line 7, $250,000. My line 8 of this form, 100%. That gives me $250,000. Okay? All right? So I have that. Then down at the bottom, it says on line 12, multiply 11 by 50% for special depreciation allowance. So I'm going to get $125,000 for line 12. Then I subtract 12 from 11. This is your basis for depreciation. So now, for 7 years, I'm going to depreciate $125,000. My first year is that 14.29 to get me to a depreciation in 2016, or the first year of that widget press, of $17,863. Okay, so I'm going to put that in my depreciation. Okay, so 2016 depreciation is going to be $17,863. All right, so That being said, if I take and I add those three together, I have $642,863. So that's a big chunk of my $750,000 for my equipment that I'm required to depreciate for 7 years that I can take in the first year against my $10 million in sales. Okay. If I were to take and just do normal depreciation of 7 years on each one of those, okay, and as they would fall in their category, all right, I would have my $750,000, and I would take and put that times my 14.29. I would only be able to take $107,000 of depreciation expense in the first year. It's a big difference from $642,000 when I'm looking at $10 million in sales. So you can see how we can use these depreciation, Section 179, the special, and the 2000 or the current year's depreciation with special allowance to really front load and put the expense of that capital purchase against income in a year. Okay? All right. Any questions on that? I'm sure a lot of you are going to come back and watch this video and go, we got to go through that again. Okay? I'll be sending out the answers to the exercises, but I wanted to go through this one because it has all three in there. Okay? So now you can see why there was only one little maker's worksheet that we did, because we took the first two presses and took a 179. So really the calculation would just be 250,000. We could go through all these lines, but we really don't have to. We use this one just to go through our our third machine, the 250,000. Okay. All right. Okay. We have depreciation again, a little portion here, some things where you'll be putting some different stuff in there. Okay. All right. Now, set depreciation aside in your head. I know that there was a lot going on there. Okay. But what I want you to do is just kind of set it aside, and we'll kind of take off on a different subject and kind of keep everybody from being dizzy from depreciation. All right. Business use of home. You can use your home, take that off as an expense if it's a portion that is regularly used and exclusively used for business. All right. Classic question. I have a bedroom. I have a third bedroom. I have one for my wife and I and one for my child, but we have a third bedroom in the house. That is our home office. Okay. 4 walls, I'll give you that. Is it exclusively used and regularly used for a home office? When it's a bedroom and there is a bed in it, contrary to the fact that that bed is covered in papers from work, that bed is not a filing cabinet. It is a bed. So it is a bedroom, because each month when my son comes home from college or grandma comes to visit for Christmas, it's a bedroom. And it's not a home office, okay? It's a bedroom, all right? So again, very careful with these, because you cannot give that home office, whether it be a W-2 employee or self-employed, and just give them the home office because they say they have a home office or they work out of their home, okay? Now, you can do where the fact that there's a area, if you will. You know, some people say, well, I have an area in my home in my basement that I threw down a rug. That's my home office. Okay, well, that makes a little more sense. It doesn't necessarily have the 4 walls, but, you know, it doesn't, you know, as it says here, the space does not need to be marked off by a permanent partition. All right, so I guess it's saying that if I put some blue painter's tape down on the floor and put myself in a little square, that's my home office. Okay, again, you know, that makes a little bit more sense than the fact that it's a bedroom. Or people say, yep, I put the birdhouses together on my dining room table and we haven't eaten dinner in that room since I don't know when. It's a dining room. It's not a home office, okay? So we have to be very specific on that. Now, as far as the expenses for a home office, okay, we have to figure the deduction a couple methods. One, we can use the 8829, and we can calculate those expenses that we would use for based on the percentage of the home that the business home office is. Again, we're going to see this when we do one of the problems that we have. But you can do that and take the mortgage, the property tax, the homeowner's insurance, the utilities, anything that relates directly to that little home office type thing, you can take that, and then a percentage is then given. But if I use 10% for my home office, I can only carry 90% on my personal return on my Schedule A for itemizing, okay? Can't double dip. Can't use 110% of your mortgage by using 100% on your Schedule A and 10% on your business, okay? Now, the other option that we have is using the simplified method. And again, sometimes this becomes the most popular. It's just like we found with our 54 cents a mile for our home office, all right? We can take and we can do $5 per square foot for our home office, all right? Limited to 300 square feet. So really a $1,500 limitation. Again, 9 times out of 10, this is going to be the best deal, is taking $5 a square foot than when we do the 8829. All right. Now, the one thing I will say about the home office, and I will make sure everybody is aware of this, is that when you do a home office, either on the 8829 or you figure it out using the simplified method, home office is taken as an expense after you have figured out your tentative profit. What I mean is, we've had our gross receipts, we've subtracted our expenses, we have a tentative profit. If that is a loss where we have negative, we had a loss this year because we had a bunch of purchases and we really didn't have the income to match, I cannot use my home office to go further negative. Equally, if I had a very small profit and I have, say I had a $500 profit and I had a $1,000 home office expense, I can't take my profit and turn it into a loss with the home office. I can't go negative. I can go to zero, but I cannot go negative, okay? So again, home office is there as an expense, but is calculated after your tentative profit, okay? We see here the little part from the 8829 that I was talking about. Is it direct expenses, okay? Again, you know, if I have something that is directly to my home office, I can take 100%. Most of the time it's indirect. I have to use my percentage. I've calculated my percentage of my total square foot of my living space for the home office, and then I have to use that percentage, okay? All right. Clergy. Let me make a note. I'm going to send out the little clergy cheat sheet for tax-wise for you, okay? But as far as the clergy, all right, make sure that with the clergy that you understand that most clergy members get a W-2. It'll have something in box 1, and they really don't pay Social Security, Medicare, or taxes on their withholding on their W-2s, okay? So you got to do a Schedule SE or self-employment. They don't necessarily go on the independent contractor, but there's just a flow that they have to do that. You have to take into account some housing allowance, okay, and subtract those out. Probably won't see a lot of clergy. Esther does quite a few. I have a few, but you just have to make sure you understand. And again, the little cheat sheet that I'll send out on the clergy will help you explain to C, because there's several worksheets that you have to do to get that in there. Okay. Self-employment health insurance deduction. We talked about this in the adjustments to income, so we've touched on this. But again, you know, you take that if you are self-employed and you're paying your cost of your health insurance from people that are on the Schedule C, okay? If you're covered by your wife's plan and she is a W-2 employee, you would not qualify for this. So you cannot take that, okay? So just make sure you understand the rules. Again, that's why on the Schedule C, when we see the line for insurance, it says not health, okay? All right, self-employment tax. Again, the self-employment tax is basically a sole proprietor or individual business paying their Medicare and Social Security on their tax return, okay? However, a person who's self-employed must pay self-employment tax if they had net earnings, a profit from self-employment of $400 or more, okay? So if we end up breaking even, we're not going to pay self-employment tax. Or if we had $200 profit, we're not paying. So $400 or more, okay? Basically, the self-employment tax rate is 15.3%. this is where people, when we talk about estimated or they're in sole proprietor business, they say, well, how much do I need to set aside? Generally, a good rule of thumb is 25%. So if I have somebody that's running a net profit, okay, and they know what that net profit is, I'd like them to make sure they're setting aside 25%. If they're not keeping track of income expenses on a regular basis as it happens, and they're just kind of waiting to the end of the year to see where they've come out, and some people will be that way for their small self-employment or second job that's self-employed, then on that gross, make sure they're withholding 25%. Last thing you want to do is have a client come in that's self-employed and have sticker shock because they didn't set aside any money to pay tax on their profits, especially if it's a low overhead or no expense thing. They make $10,000, could have a big impact on their return. And if they don't have a portion of that $10,000 set aside, then they're going to be hard pressed to find a way to pay tax on it. Okay, so make sure that they understand that. All right. The self-employment tax form you can see here at the bottom talks about how the calculations are. You can see where it has. Self-employment tax, if the amount on line 4, again, I'm looking at line 5 down here. Okay. If I look at it, the self-employment tax, there's our rate. Okay. Says if the amount on line 4 is $118,500 or less, multiply it by this, enter the result. If more, then I have that little Medicare tax at 2.9% that I have to put on there, and then add an additional to that. So if they have a sole proprietor on a Schedule C and they're making more than $118,000, A, they're going to really get hit with self-employment tax, and B, you need to have a conversation with them about having them become a S Corp. Okay? All right. I had a question that says that the rate is 15.3, and then why did I suggest 25? I'm taking into account not only the self-employment tax, but I'm also taking into account that they didn't have federal withholding like they would on a W-2, so I'm doing the income tax as well. Okay, so I'm trying to make sure that it would be just like they do for a W-2, where you would have federal tax withholding if they're not doing estimated payments, and enough to cover the self-employment tax. So that's where I'm getting into that 25%. I'm taking into account income tax, Social Security, and Medicare, all three. Okay. All right. Okay. So we have our self-employment tax. We talk about that. Okay. Have a little exercise. We're going to do some problems here, so we're not going to worry about that, but those are some exercises for you just to kind of fill in forms within the book there, doing some different calculations on each one of those. Okay. All right. So we have gone through our problems here, or excuse me, our textbook. What we're going to do next is we're going to do some problems here. Okay. All right. And give me 1 second here. All right. So I don't know if you want to go ahead and get started while we're on break here. Let me get to my problem here. Okay, so we're going to do Barbara Young here. Okay, so we have Barbara Young's problem 13.1. So we're going to start. So if you want to get in there, we have the bio information there for her. She has some dividends. But that's about it. Most of the other stuff's going to come on our Schedule C. So we'll be doing that. We'll be doing the problem out of 14 that works with hers, that talks about depreciation. Okay, so we're going to take 5 minutes. We're going to do, like I said, if you want to start working on that problem, and then we'll come back. We'll go through the problems on the two pieces there. All right, be right back.